Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial. I'm on the web at elevationfinancial.com. Today we're going to talk about home improvements, what home improvements increased cost basis of your home, and why you should care. Kind of a niche, nuanced little topic here, but home improvements are a really good way to get more out of your home. Obviously, some of us like to add on to our home, renovate stuff, kitchens, bathrooms. It's pretty common to want to upgrade your home by doing some of these things. But did you know that home improvements can also reduce your taxes when you sell your home? So when you sell your home, you need to be aware of two numbers: cost basis and sale price. The sale price is pretty obvious. It's how much you sell your home for. But the cost basis is something many people don't keep track of. It's the original value of the home when you bought it. So why is this important? Because when you sell your home, you might pay taxes on the difference. So let's talk about capital gains basics first. So capital gains tax is calculated based on the profit you make from selling your home. It's the difference between the sale price minus selling expenses and your adjusted cost basis, which includes the original purchase price, certain closing costs, and any qualifying home improvements. So capital gains taxes are categorized into two types: short-term gains for properties owned for 1 year or less, and long-term gains for properties owned for more than 1 year. And long-term capital gains are typically taxed at lower rates than short-term gains. Either way, you generally pay taxes on capital gains, whether it's short-term or long-term. So before we move any further, let's also talk about the exclusion amounts for a primary residence, just to kind of be aware of that. So the IRS provides a significant tax benefit for homeowners selling their primary residence. So as of this published date, up to $250,000 in capital gains can be excluded from taxation for single filers, and the exclusion amount is doubled to $500,000 for married couples filing jointly. And to be eligible for the exclusion, you have to meet certain criteria, including the home must have been your primary residence for at least 2 years out of the past 5 years before the sale. You can't have claimed the exclusion on another home sale within the previous 2 years, and the exclusion is generally not available for properties used primarily for business or for rental purposes. So let's look at some examples here. So for example, let's say you and your spouse bought your home for $250,000 and sold it for $600,000 after living in it as your primary residence for more than 2 years. Let's say you lived in it for a while, a long time. So the property really went up in value. Your adjusted cost basis in the scenario, including qualifying improvements and closing costs, let's say is $300,000. And this is calculated in this hypothetical example by saying $250,000 as the purchase price, plus any closing costs and home improvements. We'll talk more about the home improvements part of it in just a minute. But let's say that ends up being your cost basis. So your sale price, $600,000. Your adjusted cost basis, $300,000, and the difference is $300,000. So your capital gain in this instance is $300,000. 600 minus 300, 300. So your capital gain of $300,000 in this example falls within the $500,000 exclusion amount for married couples filing jointly. So you would not owe any capital gains tax on this particular sale. The capital gain is still there, but it falls within the exclusion amount, which gives you as kind of a freebie amount that is excluded from capital gains tax in this example. However, let's look at a different example. Let's say you're single and you bought a house for $300,000. Maybe it's in an up-and-coming area of town. You live in it for many years, and eventually you sell it for $700,000. Let's say your adjusted cost basis after home improvements and closing costs is $310,000. So let's say you got some closing costs. Maybe you document a few home improvements. Again, we'll talk about that in a minute. And your adjusted basis ends up being $310,000. So your sale price is $700,000 minus your adjusted cost basis, which is $310,000, which is a capital gain totaling $390,000. So the exclusion for single filers is $250,000. So therefore, you'd pay capital gains tax on the remaining amount, which is $390,000 minus $250,000, which is the exclusion, leaving us $140,000 that is subject to capital gains taxes. So as you can see, having a higher cost basis when selling your home can be advantageous because it can reduce the likelihood that you'll pay capital gains tax. So how do you maximize cost basis? So keeping track of your home improvements can be a great way to reduce capital gains tax when selling your home. So how do home improvements increase your cost basis? Home improvements can increase your home's cost basis by adding to the original purchase price. So when you initially buy a home, the purchase price establishes the home's original cost basis. Any qualifying home improvements and renovations you complete after buying the home can be added to that original cost basis. So, for example, if you bought a house for $300,000 and later spent $50,000 on a kitchen remodel, your new cost basis would be $350,000, which is $300,000 original purchase price plus $50,000 in improvements. So increasing the cost basis through home improvements is beneficial because it reduces your capital gains tax liability when you eventually sell your home. The higher the cost basis, the lower the capital gain. So, which home improvements increase cost basis? Is there a list? The most important thing first to understand is the difference between improvements and repairs, and they're treated differently. So, improvements refer to significant enhancements made to your home. They increase its value, they extend its useful life, they adapt it to new uses. There's substantial changes that go beyond routine maintenance. So, while there's no specific list of every possible home improvement that qualifies, there are some examples of home improvements and some general categories that give you an idea of what they are. So, things like adding a new room or a new space to the home, remodeling the kitchen or the bathroom, installing a new roof or HVAC system, adding a deck, a patio, a swimming pool, upgrading to energy efficient appliances or solar panels, making structural changes like adding or removing walls, for example. So, things that increase the usefulness of your home or add to it or upgrade it, things that enhance it overall. The cost of improvements is added to your home's cost basis, increasing the cost basis for tax purposes. So this can lead to lower capital gains taxes when you sell the property. Repairs, by contrast, are maintenance activities done to keep the home in good condition. They don't significantly increase the property's value or extend its useful life, but rather address issues to maintain existing condition. So examples of repairs include fixing a leak roof or plumbing, repairing broken fixtures or appliances, patching cracks or walls or floors, repainting walls, or replacing worn out carpeting. Repairs don't increase the cost basis of your home. They're necessary for upkeep in the home and maintenance, but they're considered routine maintenance and they don't add substantial value or substantial longevity. They're just kind of maintaining the home, stuff you would have to do for keeping it up. So again, these things do not increase cost basis. So improvements increase cost basis, repairs do not. So let's talk about documentation as we wrap up here. So you'll need to document every home improvement to establish the highest possible cost basis when you sell your home. So some ways to keep track of this include keeping receipts and invoices. So save all your receipts, all your invoices, contracts, anything related to home improvements. This includes things like materials, labor costs, permits, any other expenses directly associated with the improvements. Record dates and descriptions. Make a note of the dates when improvements were made, provide detailed descriptions of the work done, and this helps you establish the timeline and the nature of the improvements for tax purposes. Photo evidence. Photos or videos should be taken, before, during, after the improvement projects. And you want to have that visual evidence just as a backup to showcase kind of what really happened and what the before and after is. And, also maintain digital copies. Create digital copies, scan your receipts, scan invoices, make sure everything's digital so that you can organize it digitally and make it easy to pull up and reference if you need to. Also organize by project. So organize your documentation by the project to make it easier to track, make it easier to retrieve, to pull up when you need it. Use digital filing systems and folders for every project. Also, as you're working through all this, when you're selling your home or when you're doing your taxes post sale, make sure you consult with a professional. Work with a tax professional to make sure that you're doing this properly, and keep your records for for a while. Even after you sell your home, keep these records because if you ever audited, you want to be able to produce the documentation that is evidence of the improvements or increase to basis through home improvements. So, by maintaining records of all these improvements, you can really maximize your chances of increasing your adjusted cost basis as much as possible when you're selling your home. And that can minimize your capital gains taxes that you might pay. So a lot of people don't do this. A lot of people don't keep track of all this stuff. But when it comes time to sell their home, especially if you've lived in it for a while, you can really have a pretty, big capital gain there if it's been a while and your property has increased substantially over the years and the exclusion maybe doesn't cover all of the capital gains. You want to increase that basis as much as possible to reduce the capital gains tax you might pay on that sale. So keep that in mind, document everything, and that'll help you reduce your taxes potentially when you sell your home. All right. As usual, you know where to find me. If you don't know where to find me, just in case, I'm at elevationfinancial.com. You can always reach out there. Pretty easy to find. You can reach out through my website. You can schedule a consultation if you're interested in, maybe exploring working with me as a client, or just find me on social media. I'm always happy to answer questions. So with that, thanks for joining me today. Have a great day. We will see you next time.